Hey traders, welcome to Charts and Coffee. Great to see everybody. Happy Thursday, everybody. All right, so as always, I'm going to dive into your questions. Quick pit stop at the Forex Factory calendar, not because it's about Forex, but because this is a fantastic calendar that covers a global economic event picture. So all those different high impact hot zones that are likely to trigger volatility. And also remember, the macroeconomic needle that moves is not one that is truly a day-to-day or clearly not an intraday conversation. What it does is it's going to leapfrog from data point to data point, and we look at the rate of change of these different data points. So with that being said, anytime we have an inflation number, a growth number, jobs numbers, and any kind of central bank activity, then we've got a shot at seeing the kind of volatility that could change sentiment, clearly could give us volatility and could change momentum, and ultimately, really cumulatively, does it change a trend? Okay, remember, macro is akin to tectonic plates, right? Sort of under the surface of the market, of the landscape, and they're very slow moving. But once they get going, you know how that works in geology: earthquakes and volcanoes, right? But it's a very slow moving rate of change type analysis that we use data points to sort of mark our way. So we always want to take a look at what those volatility events are, because if we're trading intraday, these volatility points could create a lot more risk than maybe we anticipated. And if we are looking for volatility to close the distance to our entries, these high impact economic events, I call them hot zones, right? It doesn't matter if it's in the US, doesn't matter, really what it is, as long as it's scheduled and as long as we expect there to be some volatility, we need to pay attention to them. All right. With that being said, pretty quiet for the most part in the US, but we do have some movement in Europe in terms of potential volatility. And that does, and if you've been listening to me talk in the free videos, which you can see over at the Simpler Trading YouTube channel, might be exactly where you're watching me right now, then you'll see that we've been talking about the dollar and buying dips in the dollar via DX futures or even the UUP ETF. We've been wanting to get long dollars. So that looks like it's a brewing today. All right. So with that being said, just a quick overview of what's going on in the markets. Good morning. Good morning. And first up, how about 6E for UUP entry today? Yeah, I think there's a really good chance we could see that today. Some traders prefer the euro over the dollar for a couple of reasons. Once upon a time it was liquidity, but the dollar index, the DX futures, you need the Intercontinental Exchange to access. Most traders do not have access to it, but they do have access to the CME. That's probably the most widely accessed market out there. So, when I look at, and I've been putting my trades on index cards or little business cards for forever. And yeah, the UUP card is up. So I don't know that I would use 6E for UUP, Battlehawk. You could use 6E for FXE. But yeah, if you want to get long puts in FXE or long calls in UUP, I wouldn't say it's quite 6 of one, half dozen the other. They're not that equal. Your most direct path to a dollar buy is actually against the euro, because UUP is representative of that dollar index basket, which is euro, yen, pound, etc. It's mostly euro, but it's a basket of other currencies. So yeah, I do think that is going to be something we will see a setup for maybe today. Yeah, so definitely, if you're in the mastery, if you're in the futures room, stay tuned. It's on the radar. Yep, absolutely. All right, next symbol on our list here is Alcoa. And see, I'll tell you this. I like the idea of some of the stocks that Alcoa hangs out with, meaning when I think about Alcoa and the groups. Now, those of you that have been following me a while, we've been making sectors and ETFs and the understanding of the passive investing universe really important for a long time because we understand attention, flow, and really what I call a pre-curated watch list exists in ETF. What the heck does that mean? What it means is there are groups of stocks that will move together like schools of fish now. And knowing what stocks are in that school, if you will, is more important now than ever. And I'll say the same thing next year and next year and next year because ETFs are becoming more influential than ever. So this becomes an XME conversation. So there might be some names that we could consider within the XME. So what I'll tell you is, what I tell my folks in the Sector Secrets Mastery, take a look at the stocks within the XME and focus on the relative outperformance. Are there stocks within XME apart from Alcoa, that have better structure? And this would be one of them. So this is a little bit of, one of the things we talk about here in the office. And Trish and I were talking about this just yesterday was the whole, I remember those eat this, not that books. Well, there needs to be a trade this, not that. And I would say this is kind of a down to interesting group of stocks in XMENC. Trade this, not that. I would look at MP or other more bullishly structured relative outperformers, unless you want to play the short side of XME, in which case I would look for the relative outperformers to the downside. Yes. What are the best shortable names? And that's a really good way to, well, build a watch list. Use these ETFs, play that relative strength. All right. Next up is, hey there, how are you? Can I please share my thoughts as to why, unlike the broad market, XLF did not rally? Yeah, so XLF, it was a little unfortunate. Sometimes when we are looking at an individual ETF, we need to look at the composition, right? So what's holding? So the question really is, what's holding XLF back? Now it will be up a little bit today. It's going to wake up around 30, yeah, just above 39, which is fine. It's gonna, for our trade, it'll be fine. But we have to ask ourselves, what's JP Morgan, what's Berkshire doing? And with JP Morgan trying to head higher, with Bank of America trying to head higher, we're seeing some of the heavier weighted names getting out of their own way. So why did it not benefit? I'll tell you what. Um, I don't really, I don't really have a great, I don't have an opinion on it. I don't know because normally in this environment, historically, when I look at the years where we're dealing with monetary policy shifts and the market's going hawkish. Now, Powell was not as hawkish as I think some corners of the market might have thought he would be. And really, the only thing it can come down to is this is not a trend right now, although it is bullish. You can have a bullish market, but not have an uptrend. And I think at the end of the day, maybe it's just not hawkish enough. I mean, really, is XLF going to benefit from a quarter point bump? Or are we needing half a point, three quarters of a point cumulatively before we see XLF benefit? My hypothesis is it's going to play catch up. It's going to end up playing catch up. So yeah, it's a little, I'll tell you straight up, it's a little perplexing to me, but I will trade what I see, and it's not as short. And what we did, as you recall, being a Sector Secrets member, we waited for that down move, took advantage of the bearish momentum so we could reduce our cost, right? We don't want to buy the calls in an up market. We don't even want to focus on a lot of chop, but I do like the macroeconomic implications for this. I like that we're long. I like even better where we got long from, but a little perplexing as far as sort of why it's stuck in the mud. Sometimes it's okay just to say, look, I can see what the markets are doing and I know where the trade is, but the why is hazy. Sometimes the why is hazy. Now, look, I think there's traders out there, or I should say analysts, because most traders I know don't get too hung up on the why. We couldn't possibly know everything about all the intricacies of this giant thing that we look at called the markets, not just stocks, but stocks, ETFs, futures, Forex, the derivatives, all of it. Sometimes we just trade what we see and just say, look, I know what I want to do. I know what I can see. I may not know why it's doing what it's doing. I'll let the geniuses on television. I'll let them sort that out. But Microsoft is finally getting going, which is great. Microsoft should play catch up to the XLK, should play catch up to Apple. But Tracy, yeah, when it comes to Microsoft, and I'll touch on that Google as well. When it comes to Microsoft, let me show you what we did do and see how helpful this is for you when you're making these decisions going forward. Tracy, number one, Microsoft isn't super expensive. It's not one of the pricier names within XLK, but it can be a little, as we like to say in the room, a little spendy, right? Cost does equate to a certain amount of risk. So now we have this Microsoft conversation. We know Apple is strong. We know XLK is an ETF, has them both, and it's far less expensive to trade. What we did is we played XLK in an effort to take advantage of that parabolic Apple stock, that Apple chart, and still have exposure to Microsoft, although Microsoft isn't quite moving. This is just a matter of watch list building. I'm bullish Microsoft, but if my job is to find the better setups, better structure, better relative outperformance, XLK wins. But if you're long Microsoft, it's really the same, very similar conversation. If you're already long Apple, enjoy. But don't buy any of the highs. Take advantage of the pullback. And that's basically what we did. So when you're looking at a stock, if you also take a look, so I'll call the stock a boat, right? Look at the boat and tide effect. And that's really where I think the tide, the XLK, was the better way to go. As far as Google goes, here's where I'll say play the boat. Because yes, Google is weighted within the NASDAQ, QQQ, NQ, whichever flavor NASDAQ you like to trade. But it's also part of this XLC, which has really been struggling to gain traction, mostly because of the weighting of telecommunications within this communication ETF. So Google's going to have to really motor against outgoing tide in the XLC. So I have no problem with looking at Google. It's probably the most bullish and best corner of XLC in terms of the heavily weighted names. But I've really been sort of shying away from it for the most part because it has to work harder. Let's find something that doesn't have to work quite as hard, right? So to your Microsoft point versus Google, it's not versus, but you had a question about both. I would focus on Microsoft XLK because now you've got a pretty good boat in Microsoft and you've got a great tide, rising tide. So hope that helps. And that's really, in many ways, the philosophy of what we do. If we're an index trader, if we're an ETF trader, and we understand that these are curated groups of stocks that have a synergy. And if we can capitalize on that, we're going to build better watch lists. We're going to have a much better relative outperformance understanding. And high concentration weighting is why really so much of this is so important to understand in that grouping, because in the indices, S&P, NASDAQ, Dow, and in most of the influential sector ETFs, very few number of stocks account for most of why that overall market would move. KRE, one of the few non-high concentration weighted stocks. Michael, KRE was very good to us through November, probably October, November, and into December. The wheels came off the wagon. It's an oversold buy scenario. If I'm going to get us back into KRE, it's probably going to be closer to 68.80, quite frankly. I'm going to get us back in here. That's likely going to be where I'll focus on whether or not we're oversold, hitting support. Darvis says we are. A volume ledge right in that area also says we are. So somewhere between 68.80 to 68.50 is what I'm looking at, both at a price-based pattern, Darvis, and a volume ledge, volume profile, right around 6850. So thanks for the question. What about healthcare? Hey there, TT. What about healthcare? It's heading higher. Um, I'm not going to buy near highs, and I need some sort of even minor pullback before I do it. It should keep moving higher. But this is where, well, you know, this is actually a really good lesson in a few things. My mastery folks know this. Most of you who've attended any of my classes know this. A staple in all my trading style is pre-identifying a zone. And then once we have that zone identified, we scale in. Now, one of my reasons for focusing on lower cost options is because I want there to be a range where a trader can get into a certain number of contracts, not just one, because that's affordable, but rather think about an aggressive level, a moderate level, and a conservative level from which we'll scale in with our budget, our spend in mind, and a certain percentage of our budget spent buying the calls or puts at each trigger. So this allows you to do a few things. One, it allows you to plan ahead with your entries. And two, it allows you to say, well, if the aggro, the first opportunity, is a little too expensive or a little too much risk, I can pass on that and focus on moderate and conservative. It gives every kind of trader in terms of account size the ability to sort of custom, right? Custom fit the trade to their account size and risk tolerance, because you can't follow someone else's risk tolerance, right? Being both a student and then now having the honor of being a teacher, a mentor, I know that I've been on both sides of the mic, so to speak, where I remember trying to follow ideas from other traders and then realizing, oh, this is an asset manager with hundreds of millions, if not billions under management. Back in the day, I'm not trading a huge account, and then I realized, oh, this trader has a far larger risk tolerance than I've developed, early on in my career. Risk tolerance is a muscle. It's not going to be static throughout your career. But if you don't know, let's say you're working out with somebody, right? And you know what they can lift, right? But that's not what you can lift. You can't go get under the squat rack lifting something that someone who's been lifting for years and years and years and has built that muscle. You'll hurt yourself, right? Risk is that way, but you will develop that risk muscle. Everyone, I'm not talking just UTT, everyone will develop that risk muscle, and it's an ongoing process throughout your career. So with that being said, scaling in allows you to do that. That's the point of it. It's not adding to a trade, right? And I think, we'll get into this topic some other time, maybe a webinar or something early next year, but scaling in is the key, right? Because that's what's going to allow you the ability to get in. Now, why that whole preface to what looks like a very simple question? Because we scaled into the XLV. We scaled out too. We got in our aggro, we got in our moderate, we got in our conservative. This did not survive this little dip here, our aggro. This did not survive. Small, manageable, it's never personal, paper cuts, take small losses. Our conservative was able to withstand that move and keep it's the premium value that our threshold before we release that leg of the trade. So we have our conservative leg of the trade in. So I'm not going to get in with momentum. I'm going to get in with a pullback. I'm going to scale in with a pullback. So there's nothing I can do with it now, XLV. Now it's doing what I was hoping it was going to do back at the end of November, but it is regaining the traction that it once had. So this XLV has been tricky, but I'll tell you this. When you take a look at the individual stocks within the XLV, which very important, and if you're looking at XLV as a whole, I would play XLV as a whole because individual stocks can have a very binary volatility reaction to what's going on, since we're in the pandemic. And holy cow, have we already burned through 20 minutes? Gosh, gang, sometimes I get a little bit into the questions because I want you all to have some actionable ideas and just some processes to understand what we're doing. Uber, my friend, double red. Let me just crank through a few of these. Uber, double red, maybe someone else, Garrison, has a your long puts, and maybe someone else also is long puts as Garrison. Great trade. Short the rips. And if that's what you did, as far as lower lows, look, I would not be surprised if we continue to see some weakness in Uber. But remember, you have a support area around 35.50. So scale out in that area or scale out at your predetermined profit targets. Move the stop to break even, but great eye on a downtrend in terms of weakness and getting long puts. Beautiful, Garrison. I love Ford. I love Ford for two reasons. I'm a huge Mustang fan, and I like the trend. Yeah, I like the trend very much, but I like the pullbacks even better, right? So specifically the 6th, specifically the 14th, that's when we want to be focusing on getting long a double green. All right. So I hope that makes sense. All right. So just like that, my apologies. Let me grab this question on copper because I've talked about copper in the rooms. I do like copper around the 200. And I've mentioned, I know we've talked about it, and I just want to reiterate that trigger at the 200 propulsion. Look at this beautiful 200 propulsion lit up. See how the dots lit up? Beautiful. That's a buy. Assume we're going to take heat. We did yesterday, but that is a buy of copper futures or calls. Now, if you don't have the propulsion, the simpler propulsion indicator, head on over to countdowntrader.com. It's a free indicator. We've made that available free since 2016, 17. And you can put this indicator on your charts. And you can see where I would say, an 8 or 13, 21, 34, 200 exponential is more valid because the dots are lit up. All right, let me wrap it up there. Sorry for running over. I'll see you all tomorrow, same time, same station. Be good to each other.